Good morning. We have with us le gouverneur de la Banque du Canada, Stephen Poloz, et Carolyn Wilkins, Senior Deputy Governor. You can go ahead. Thank you.
Okay, thank you. Well, good morning. Bonjour tout le monde. We're very happy to be here to answer your questions about today's monetary policy report and our interest rate announcement. We'll begin with a few remarks about the issues that were most important to the Governing Council's deliberations. Carolyn, would you like to do that?
Merci, gouverneur. Mais commençons par le contexte mondial. Nous prévoyons que l'économie du globe va se raffermir au cours des 2 prochaines années, mais son profil d'évolution sera plus bas qu'anticipé dans le rapport du mois de juillet. La croissance est soutenue par la politique monétaire expansionniste et les effets positifs des bas prix du pétrole dans certains pays. L'économie américaine continue de se renforcer largement comme prévu grâce à la disparition des facteurs temporaires qui freinaient sa progression plus tôt cette année. Les secteurs qui sont importants pour les exportations canadiennes, comme les investissements des entreprises, sont particulièrement vigoureux. However, we also see weaker growth prospects in a number of emerging market economies, particularly China. Governing Council spent a lot of time discussing what this means for Canada. There has been volatility in financial markets and downward pressure on the prices of many commodities that Canada sells. China is transitioning to a lower and more sustainable long-term growth path. And while this transition may not happen in a straight line, China should continue to be a solid source of growing demand for commodities. If you look at Chart 8 in the report, for example, you'll see that Chinese imports of copper are still rising strongly in volume terms. Nonetheless, there is downside risk for some emerging market economies, particularly in the context of U.S. monetary normalizing. In our discussions, we thought it was important to keep in mind that many of these countries have become more resilient in recent years. They've been restructuring their economies, strengthening their fiscal positions, and moving to more flexible exchange rates. Given these factors, if uncertainty fades about the prospects for China and other emerging markets, there is some upside risk to our commodity price assumptions with implications for Canada. So I'll turn to Canada now. While the first half of this year was weak, there are clear signs of pickup in growth. Taken as a whole, the second half should see growth in line with our July outlook, and we expect the economy will gather strength over the next couple of years. L'ajustement complexe au choc des termes de l'échange du Canada suit 2 trajectoires. Dans le secteur des ressources, les entreprises coupent dans la production et l'investissement. Nous constatons aussi qu'il y a des retombées dans d'autres secteurs de l'économie. Ce n'est pas surprenant que les ventes des véhicules automobiles et les marchés du logement dans les régions qui produisent de l'énergie ne font pas aussi bien que dans d'autres parties du pays. Nous estimons que le choc des prix du pétrole, à lui seul, a retranché environ 1 point de pourcentage écart à la croissance du PIB du premier semestre de l'année. At the same time, Canada's non-resource economy is doing much better. Table 4 in the report shows that retail sales, housing starts, and labor markets are showing solid strength outside energy-intensive provinces. Non-energy exports also are showing encouraging signs. You'll recall that in July, we were puzzled because non-energy exports had faltered by more than would have been expected given developments in the U.S. So bank staff have updated this analysis, the analysis that they did last year, by looking at more than 4,000 export categories. This work was posted today on our website. It shows that categories of exports that were expected to lead the recovery, such as building materials, fabricated metal products, well, they have grown strongly in recent months, and we're seeing new sources of export growth that are emerging. While it's clear that there are risks to our outlook, the bottom line is that economic momentum is building in Canada. Real GDP growth should continue to increase over the next 2 years, although by less than we had forecast in July. Lower commodity prices and the drop in energy-related business investment are acting as significant drags. At the same time, stronger U.S. demand, a lower Canadian dollar, and the monetary stimulus that we added earlier this year are all having a positive effect on growth. Governing Council considered carefully the implications of commodity prices and the commodity price shock on potential output, because it's important to gauging the outlook for inflation. Potential output growth, the sustainable rate of non-inflationary growth, is a tricky thing to estimate under normal circumstances. It's even more so now due to the adjustments in investment and jobs that are underway. Overall business investment has been revised sharply lower, and this is because investment in the resource sector is being reduced faster than it is growing in the non-resource part of the economy. This means that over the near term, potential output is likely to grow in the lower part of the range of estimates that the bank presented in April. Potential output growth should eventually recover as existing capacity and expands and new firms are created in the non-resource sectors. Now, this process will unfold over a long period. Compte tenu de ces facteurs, nous pouvons nous attendre à ce que l'économie retourne à son plein potentiel vers le milieu de 2017. La tendance sous-jacente de l'inflation se situe encore aux alentours de 1,5 à 1,7 %. L'inflation mesurée par l'indice de référence est actuellement supérieure à la tendance sous-jacente car le dollar plus faible fait augmenter les prix des importations. Et aujourd'hui, nous avons publié une étude qui présente les estimations du personnel de la banque concernant l'effet des variations de taux de change sur l'inflation. L'inflation mesurée par l'IPC global, toutefois, demeure beaucoup plus faible que la tendance sous-jacente en raison des baisses passées des prix du carburant. Nous nous attendons à ce que l'inflation retourne à 2 % de façon soutenable, durable, à mesure que l'écart de production va se résorber. À notre avis, les risques entourant le profil de l'inflation sont relativement équilibrés. As part of our risk management approach to monetary policy, Governing Council always considers financial stability risks. We know that accommodative monetary policy has implications for financial vulnerabilities in the household sector. In the current context, getting the economy back to full capacity and inflation on target is central to supporting financial stability in the longer term. Taking all these developments into consideration, the bank judges that the current stance of monetary policy remains appropriate. Therefore, we kept the target for the overnight rate at 0.5%. Avec ça, et avant de passer aux questions, gouverneur, est-ce que vous aimeriez ajouter quelque chose?
Well, I think that covers the issues really well. I think there's one thing I'd like to underscore. We need to bear in mind that the effects of the policy changes we introduced earlier this year will take on the order of 6 to 8 quarters to be fully realized. So those actions turned out to be quite timely because they helped cushion the blow on the economy from the commodity price shock, which is, of course, better than reacting after the fact. But we have probably not even seen half of the ultimate effect of those policy actions yet. Now, we need to be patient and let monetary policy do its work. Now, those forthcoming effects, of course, were taken into account in today's decision. So now, Carolyn and I will be happy to take your questions.
Randall Palmer, Reuters.
Mr. Poloz, there's been much made of the appropriate balance between fiscal and monetary policy. Are you able to say whether the anticipated $10 billion in deficit spending per year will make it more likely, all other things being equal, of course, will make it more likely that you would be able to raise rates sooner, and more likely that you would not be cutting rates, or less likely that you would be cutting rates?
Well, at this stage, in fact, at any stage, I wouldn't normally comment on fiscal policies. As you know, we take them as given. Objectively, we know in any macroeconomic model, a fiscal action would have the potential to tilt the risks in the future one way or the other, depending on the nature of the action. So a pure fiscal shock is relatively easy to analyze. But of course, the world is a lot more complex than the simple models that we carry around. So pure fiscal shock meaning a pure increase in spending as opposed to changes in taxation of various forms, whether on companies or on individuals. That makes it a lot more complex and is a subject for a more fully articulated fiscal framework model like they use at the Department of Finance. Also depends on actual follow-through. So you may announce, let's say, a fiscal change, which would be, say, an infrastructure spend. You may announce it, and then it may take several months for it to get actually contracted, permits issued, et cetera. So in this sense, what we would know, if we had clearly announced policy changes, we would take them on board as best we could, given the information we had available. And that may be judgmental at first, and it might become more concrete as we got more detail or as the time progressed so that we could actually see how the actions were affecting things. So difficult to answer on a day like today. I think you'll understand that. But we operate in a data-dependent fashion anyway. So, you know, lots of things are moving. They're never all things equal in the way you describe. So we'd be analyzing that on an ongoing basis, and as the economy was noticing the impact of a fiscal change, then that would for sure be taken into account in our forecast.
So it's safe to say that you have not accounted for the Trudeau deficit spending in today's MPR, but you would be presumably taking that into account in the next one.
Yeah, that's very safe to say. How, to what degree we could take it into account in January would depend, of course, on when things happen and how concrete those things are when they are announced. So it's we'll have to just wait and see in January. We'll stay tuned.
Kim Mackrell, Wall Street Journal.
Hi, Governor Poloz. I apologize for my voice.
Oh, I've got that too.
Not very strong. I wanted to ask you, you spoke in the NPR and in the statement today about a transition that could take a matter of years, a long process for a transition. Can you speak to what that adjustment means a little bit more specifically in terms of what's changing and moving away from resource to non-resource, and what you see as being sort of the main drivers of growth at a time when that transition is complete? Where are we moving toward in terms of drivers of growth?
Right. Well, it's of course a bit of a convenience in a way. We try to separate the economy into the two parts and try to analyze those two parts, but they're highly interactive. So just to bear in mind, it's kind of an abstraction that allows us to think about it, but it doesn't capture the full flavor of the complexity that's involved. So, for instance, we might look at the oil price shock and we say, well, that'll be primarily borne by the oil and gas sector, but a manufacturer down the road that makes pipe or components for equipment that's used in the oil business feels it just as much as if they were part of the oil business. So that makes it complicated. But fundamentally, when relative prices have changed, which is what a terms of trade shock is, that causes the economy to in effect shift the stream of resources. The channel of growth shifts away from the original growth sector to others, and so when that happens, it means that people may be losing their jobs in one sector, picking up jobs in other sectors. Those could be geographically dispersed. So there's a process of perhaps moving, or at first you get these regional differences. So a very complex set of processes. And when we look back over the rise in oil prices, which was roughly a 10-year period from starting in 2002, we were probably only approaching having adjusted to that when it then began to reverse. That's the kind of scale that we think of these long-term adjustments on. So we would measure these in years, and so it's an undercurrent that will be in the economy for quite some time. The headline economy, though, we believe will show the other 80% of the economy both growing in its normal way, but getting an additional boost from this transformation, which is underneath. And so later on, well, up by now, actually, we're seeing the headline has rebounded, and that's because that's coming to dominate. And for sure in 2016, that'll be the dominant story. It'll be the rest of the economy. And but underneath, there'll still be those adjustments taking place. So very hard for me to put a tight answer around that, but you get the feel for it, and we'll be looking at interprovincial migration and so on for some time. Having influence, how housing markets behave, how labor markets behave, will all be influenced to some degree for quite some time by this change.
And do you have an expectation on what we'll see as drivers of growth? We'll no longer see the resource sector as much of a driver of growth? Well,
yes, it'll be the rest of the export sector is your backbone of any such growth story. It's why we've been watching so carefully U.S. in particular developments and our connection to that. And as you can tell, when we have the terms of trade shock happening, the exchange rate tends to move with it. And that happens to all countries. You can see it across the world, like Mexico, very similar terms of trade shock in Mexico to Canada's, and a very similar move in their exchange rate as ours, almost parallel. And that process of adjustment is natural. And what that does is it facilitates that process I was talking about before. So if you could imagine what it would be like if exchange rates didn't react, it would be a much slower process than this, because the decline in the currency gives a little stronger profit picture, or sows some stronger seeds of growth for, say, the manufacturing sector that had been under pressure while the dollar was higher. So that's the core of your growth story, and then of course around that is all of the things that surround it. So the services sector is serving the people who are working regardless of where they're working, and so that's why it continues to grow like about almost a 2% rate, more or less continuously.
Rahul Vaidyanath, Epoch Times.
Yes, hi, Governor. Thank you. I wanted to clarify, you've got the output gap closing mid-2017 now as opposed to first half of 2017 in the July MPR, and with lower growth forecasts for 2016, 2017. Was the financial stability aspect more of a factor here in, let's say, not lowering rates, or was it a close decision not to lower rates despite nobody expecting lower rates at this meeting? I'm just trying to understand the lower growth forecasts, right, and the output gap closing what seems to be a little bit later than in July.
Right. So I think this is a good point to remind just how uncertain you can be about potential output. It's the least observable variable, perhaps, that we have. And normally we would do a fulsome adjustment to that in our April report. Carolyn, would you like to I'll let you go to that in a second. But what I want to say is no, because the zone that we talk about where things are in balance, one of the reasons why it has a width to it is because we don't really know what potential is. And so you need to have something really big to happen to disturb that. And so yes, January, July, we felt that we had been bumped out of the zone by the oil price and then the rest of the commodity complex, that shock. But having reset things in a balanced way, it's a fairly subtle trade-off within that at this stage. But perhaps a word or two on the revision to potential, which would be in April, but we've incorporated downward judgment to it here.
Yeah, as you said, Governor, we don't observe potential output, and so when we think about potential output growth, we always think about it in a range, and so in April when we updated it last, we had a series of ranges, which you'll see in the MPR, and normally when we conduct our forecast, we just pick the midpoint of the range. You need to put a number in the model. When you look at the revisions that we've made to business investment this year, which are quite large, you see now there's a 40% decline in the in the energy-related area, and it continues into 2016. it was our judgment that we needed to take into account that when we thought about when the output gap would close. And so we just took that into account by saying, well, it's likely to be in the lower part of the range that we published in April, then at the midpoint. And now when you think about that, you need to take into account that this is an adjustment process that the governor was just talking about, and so it's not all negative. At the same time, we've got this reduction in business investment in the resource area. You're seeing a pickup in investment in the other parts of the economy, and an adjustment in labor. And so eventually, as that capacity expands, and especially if it expands with better and newer machinery and equipment, then you'll see that potential output growth will be picking up. And those are the kinds of things that we're going to be looking for as we continue to observe the data and this adjustment.
Right. So if you had not had any revision of thinking on the potential, then you'd have a different way to portray that question that you're raising. But normally we have to watch and see how potential is evolving, which is tested in various ways. But here we have very clear evidence that investment in that sector has really gone down. So that will for certain reduce the level of potential output in the near term. These other processes about new firm creation and investment in the rest of the economy, that's all taking time, but we've got evidence that it's happening. And it'll be the dominant story next year for certain. And that'll cause potential output then to resume its previous growth path. Possibly exceed it if we're lucky.
Greg Quinn, Bloomberg.
Oh, okay.
Governor, of course, your appointment was approved by the Harper cabinet. During the election campaign, the Conservative Party named you in a press release about the economic situation. Mr. Trudeau called that an outrageous bit of interference. Are you concerned that you've been politicized, that your early meetings with the incoming government might be a bit chilly?
No, I'm not concerned about that. Our institutional framework, I think, guarantees that that's not the case. The bank is formally, operationally independent with a very clear mandate. And so you can rest assured that we'll pursue that mandate and deliver on it. And we look forward to working with the new government just as well as we worked with the previous one.
On the housing market, the NPR mentions that some of the imbalances are still climbing. There have been some reports about further unoccupied condos in Toronto. Mm-hmm. Your recent speeches have mentioned monetary policy as the last line of defense. Is it a time to look at the other lines of defense and tighten some other housing rules up?
Well, as I mentioned in that speech in Washington and in Lima, we're part of an intergovernmental group called SAC that considers those issues in their full breadth. So we're a key advisor in that process, and so I would keep that analysis for that group. But I mean, there's no question, as we said in recent FSRs, and as we continue to say here, that the vulnerabilities that we've identified in the household sector continue to edge higher, and that's of course a rational response to low interest rates. So I don't think of that as an appropriate thing. It's what we would expect to see. So it's evolving as we expected. But at the same time, the fact that we acted, and you can see that the actions we took have helped to bring about this second half turnaround. What's at work there is that we're reducing the odds of there being a trigger to cause those vulnerabilities to manifest themselves as risks. A typical trigger would be, a prolonged period of weak growth, rising unemployment, those kinds of things that make high indebtedness truly become a problem. So we see as our best contribution as the last line of defense to do what we can to make sure the dynamics of the economy are supportive of a constructive evolution of those imbalances. And along the way, from time to time, we have to talk about those other lines of defense. But I think at the heart of our system, the best part is the first line of defense. It's a very strong underwriting culture in our financial system. That was the main element which gave us a better post-crisis, post-financial crisis world than other countries. And that continues to be the case today.
Gordon Eisfeld, Financial Post.
Just want to get back to Randall's question. Looking at the figures for 2016, 2017 growth figures, obviously they're going to be affected by the new government's restraint program. And I just want to get an idea, if you could clarify, how long does it take, maybe based on 2007-2008 recession and the stability program that ensued. Can you clarify how long it would take to see that impact on your economic growth outlooks? Because at this point, we're going to have to take them with a grain of salt.
Well, that's a very hard question. It depends on the underlying dynamics of the economy. Excuse me. I've got what Kim's got. But anyway, the underlying economy is we believe, moving into a stronger growth track. So that's a positive starting point. So it's risky to compare that to, say, 2008, 2009, where the economy was clearly on a contraction path. And it also, as I said earlier, depends on what form, whatever any fiscal adjustments take, how they affect the economy gradually or with immediate effect. So we really simply don't have enough information on that. As any fiscal changes are announced, we'll analyze them like every other forecaster, and we'll some of them will be perhaps faster than others, and we'll do our best to grapple with that. At first, it may just be judgmental until we get more detail and we have a deeper understanding of how they're acting. I think that's as good as it gets today, Gordon.
Right. Your next MPR,
Yes.
is that too far away or not far enough?
Well, again, I don't know. If we'll have enough information before the January MPR, that'll be built sort of during Christmas and early January. But I just don't know how fast things are going to move.
Andy Blatchford, Canadian Press.
Yes, Governor Poloz, I wanted to ask you if you've had a chance to speak to Mr. Trudeau since the election, and if you could sort of walk us through what happens inside the bank through this transition phase, how you guys prepare or deal or start looking at possibilities. How does that unfold?
Well, no, I have not spoken to the Prime Minister, and if I had, I wouldn't talk about it here. That's something we would normally do in full confidence. So inside the bank, of course, like with indeed with any new mandate in government, we prepare, briefing materials so that we can sit down and have a conversation around, what our issues are and how we're working on them. And it's primarily a question and answer kind of setting. So there's nothing very special about it. It's just that's what I'd be expecting to happen in due course.
I wanted to pick up on one of the other questions about the debt to disposable income edging higher. In these MPRs, and you constantly talk about it moving higher. How high can it go? Where's the?
Well, that's a question we don't have a lot of experience with. When we look at the data as we do in the FSR in more micro ways, more granular ways, we can do more slices of the data and get a sense of where are the vulnerabilities, how big are those vulnerabilities. So, for instance, what percentage of households have mortgages that are more than this percentage of their income? Is it growing? And where are they in the labor market? are they more vulnerable to a trigger than others? So we get a sense, a little bit more granular feel, which is what we do in the FSR and in the background pieces that go with that, which is coming up not long from now, early December. So we'll have more in-depth analysis of that then. But frankly, in the business writ large, we don't, all we have really is experience of other countries to give us some guidance in this. There are lots of countries with much higher ratios than those. That doesn't mean it's okay. I don't mean it like that, but just to say that you can learn a bit something from their experiences. And so what we take comfort from is that we think we've got we've identified the right forces in the economy. If we go back to how uncertain things were back in January and how things have unfolded, they've unfolded very much in line with what we thought they would. So that is encouraging. If you're relying on forecasting to help make good decisions, that's very reassuring. It means that you've identified the right forces. Those forces continue to operate, and the evidence of them continues to grow. And so that means if you've got the story right, that means that then the constructive evolution of those imbalances is something which will be a byproduct of that return back to full capacity and full employment.
Richard Madden, CTV.
Hi, Governor. Just to pick up a little bit more on Randall's question. Suppose an incoming government has promised $4 billion a year in annual infrastructure spending. What do you think the impact would be in the medium term to the economy?
Well, it would be around $4 billion a year.
Right. But, I mean, thanks for that. But how would you see that either lifting the economy or the impact it would have, and when would you see that translated?
So the example you're offering is what I referred to before as the closest thing to a pure fiscal shock, which is you simply spend some more money. And that's something that's well articulated in almost every macro model. And so you would, the base for that would be you'd expect to get around $4 billion per year, plus perhaps some multiplier effect. That's not a given because with any fiscal shock, you get a certain amount of leakage out into imported goods and so on. So it doesn't always have its full effect. So again, you can't just assume the answer. You just know the direction, and so you'd make a judgment around how that might affect the path we have here for output, and how that might then and when, which is very important. So an infrastructure project might take a certain amount of, if it's a P3, it takes time to structure it, takes time to permit it, takes time to get it organized and mandated, and then it takes time to get the holes dug and so on. So all of that means that how the money impacts the economy can be more gradual than the simple shock that an economist sticks in their model. So for all those reasons, I'm saying it's not a simple question you're asking, and that's the simplest version of the question you can ask. All the real questions are much more complicated than that one. You agree? Yeah.
Okay. And a completely unrelated question. When you look at your model and you see that the energy sector, you anticipate less growth in the energy sector, but you're banking on the manufacturing sector to be the main driver of the economy. Where do you see the direction of the loonie in the medium term?
Well, the Canadian dollar has been, as I said before, been moving around roughly in line with shifts in the terms of trade, which is what it has done historically. It has behaved roughly like that, and I say roughly with a lot of advisement because the zone of error around that is not trivial. It's quite a few cents. So as I said before, it's like when you're walking your dog with one of those stretchy leashes. You do get home together, but the footprints don't look like train tracks. So the dollar is following the terms of trade the way a dog follows its master on one of those stretchy leashes. So, but as a general rule, it seems to be reacting about as historically it has. And so, if the terms of trade settle where they are, then you wouldn't expect any significant more moves in the dollar, unless something else happened to disturb it. but it's everything in the economy that can move tends to feed back somehow onto foreign exchange markets because, at a minimum, because they feed back on people's expectations about both long-term and shorter-term interest rates. And if the factors underlying it are global, which is very often the case, then it's not even something you point to here in Canada. It's something going on in the oil market or in China or someplace, which is an exogenous, a truly exogenous change.
Rudy Lecourt, La Presse.
Bonjour.
Bonjour.
Ma question porte sur l'inflation et le dollar canadien.
Oui.
Dans votre scénario de juillet, vous aviez un dollar à 80 cents, là, vous le placez à 76 cents. L'effet du taux de change sur l'inflation est positif. Ça crée de l'inflation pour les biens importés. Compte tenu que le taux de change dans votre scénario est maintenant plus faible, comment se fait-il que l'inflation reste très, très faible en 2016 et que soudainement, dès 2017, l'inflation globale revient à 2 %? Qu'est-ce qui se passe? Pourquoi l'effet du taux de change ne se prolonge pas plus longtemps? Ou à l'inverse, pourquoi on n'obtient pas 2 % plus rapidement qu'en 2017?
OK. C'est une excellente question, Rudy. Et nous avons publié aujourd'hui un papier de recherche qui discute exactement de cela. Et comme expliqué, là, ce changement dans les effets, c'est un effet dynamique. Okay, nous avons un choc autour de 25 cents en total, là. Mais c'est un choc dans l'étape. C'est graduel, mais en étape. Alors, les effets commencent avec un choc partiel. Les effets sont là. Puis, quelques mois plus tard, il y a un deuxième choc. Ça commence. Alors, c'est un effet cumulatif. Et c'est pas quelque chose qui est calculé dans une façon mécanique, mais c'est estimé avec plusieurs façons là, dans le papier. Alors, on estime une fourchette des effets. C'est une fourchette pas statique, mais dynamique. Parce que l'effet d'un choc il y a 12 mois, et c'est peut-être presque terminé maintenant, mais un autre est là. Et les deux sont présents en même temps, mais un disparaît graduellement, immédiatement presque, et l'autre juste commence. Alors, c'est une question très complexe. Alors, et ce n'est pas une chose où on ajoute le choc, comme vous avez mentionné. C'est un effet que chaque fois, on estime les effets totaux avec un exercice fraîche. OK. Alors, j'imagine que ce papier vous intéresse beaucoup. Ça va vous donner les détails. Et un graphique, graphique 5, qui donne l'effet dynamique et le sommet de cet effet, puis la période après. Alors, je pense que c'est la réponse.
Any other question? D'autres questions? C'est bon? Merci beaucoup.
Okay. Merci. Thanks, everybody.